Hello friends, welcome to the second bonus video or the last video of the day, video number 17 on mutual funds. So in this I'll be discussing a few pertinent concepts. The first concept which I'm going to discuss is the PE ratio. This is the ratio which you might have encountered on every mutual fund fact sheet or every one which is there, or even on the stocks you might have encountered. What exactly is a P/E ratio? It is basically the price to earnings ratio. It is the, you can say, the relationship between a company's share price and the earnings per share. So it denotes what the market is actually willing to pay for a company's profits. If the company is doing well, so more and more people will actually invest in the fund house or in the company stocks. So the earnings are substantial when valuing a company stock, because people want to know how profitable the company actually is. But if the growth and the level of earning of the company remains constant, then you can say the PE is interpreted as a number of years it will take for the company to pay back the amount paid for the share. So investors often look at the PE ratio as a good sense of the value of the company, and helps them analyze that how much they should pay for the stock based on its current earnings. So how is the PE ratio calculated? PE ratio is market price per share divided by earnings per share. You don't need to calculate it. Again, these ratios, these numbers will be given by itself only. If I have to just simplify and explain you what it is, for example, suppose the current price of the share is, you can say 90 rupees, and its earning per share is rupees 9. So what is the PE ratio? The PE ratio will be 90 divided by 9 is equal to 10. So it can be seen that if the PE ratio is 10 times, that means the investors are willing to pay 10 rupees for every 1 rupees of earnings for the company. That means the stock is pretty much common, pretty much popular amongst the investors. So what does exactly the PE tell you about a stock? So you can say, where you can tell very clearly whether the stock is undervalued or overvalued, because there have been certain sectors like diamonds, fertilizers, which actually command a low PE ratio. But then there are sectors like FMCG, pharma, IT, which always have been traditionally having a higher PE ratio. So you can always make a comparison based on that, why it is a high and why it is a low PE ratio. So usually the growth stocks will have a high PE ratio. That means the investors have higher expectations from those companies or stocks to give them more. So that means they are willing to pay more to have a positive future performance from these kind of stocks. So similarly, the disadvantage of the high PE is that the growing stocks or the growth stocks are sometimes unpredictable, and this puts a lots of pressure on the companies to do well, to justify their higher valuation in the minds of the investors. So therefore it can be a risky investment sometimes for the investor to invest such in the growth stocks, because sometimes they might be overtly high valued. So also in some cases you can say they are overpriced stocks as well. So for the low PE, you can say if some company or such stock has a low PE ratio, they are known to be the undervalued stocks. But then the undervalued stocks can sometimes become the underdogs as well of the industry. So a low PE ratio means weak current as well as a future performance indicator, and investors are not having much of faith in them, and they are very wary of investing of their future, considering they don't expect the future returns by much in those. So the third is the justified PE. You always say it is the standard PE, it is calculated in a similar manner. So both the PE, the justified PE, should reproduce different results. You can say if the PE is lower than the justified PE ratio, that means the company is undervalued, but it is giving actually more returns. So you can say if the stock will result in profits, the alpha is going to be close. So what conclusion can you draw from it? The conclusion is that whether the P is high or low, it depends upon the sector. So the IT telecom will always have a higher PE compared to industries like manufacturing, textile, etc. So PE ratio is dependent upon external factors as well. Sometimes like a merger and a acquisition by a company will increase its PE ratio if it is going to merge in a higher profitable company. So it is always better to have a look into the backdrop of the company if you want to invest in a company with the accordingly the low or the high PE, to check out its valuation. So the last topic which I'm going to discuss in this 17 videos of series of mutual fund is the return over investment, the ROI as we say. So always when you invest in something, you always expect a return, and it is more important that you track your return, and more so like mutual fund, which you always would be expecting a higher return compared to the debt instruments like FD or any kind of a PPF as well. So you can say there are various measures to actually gauge the same in such a way, because every investment would have a different purpose. We are not always putting in all our money in the equity. That equity will grow by 12 to 15%, so put in all money in that. You have to balance that out, because sometimes some money would be locked, some money would be required in the short term, because in the short term the equities might even give you a lesser return than a debt fund as well, or a debt instrument as well. Equity is supposed to give you a long term if you stay invested for a longer time. If you compare the sometimes, not always, sometimes the SIP returns of a 3-year debt and a 3-year returns of equity, sometimes the equity return might be a tad short. But yes, it is over the period of advantage when the profits are reinvested as a growth part in the equity part. That is where the compounding happens, and coupled with the great variant time, it actually grows into a bigger amount. So similarly, you can actually check out the potential of the returns by checking the ROI history or the performance evaluation of a fund. Again, everything would be available in the document or the fact sheet. And again, ROI is a comparison metric, you can say, which will understand you the return factor of the investment, and then you can optimize your financial portfolio accordingly. So how do you calculate the ROI? So ROI is basically your investment gains minus investment cost divided by investment cost. So you can say the gains means the total amount earned after redeeming or selling the investment. For example, you actually say invested 10,000 in a mutual fund, and when you redeemed after 1 year, the fund value was 15,000. So 15,000 minus 10,000 divided by 10,000. So the answer is 50%. 5,000 divided by 10,000 into 100. So answer is 50%. The fund has given you 50% returns in that matter. Again, a very high percentage. But then, for example, you make a lump sum of 50,000 in an equity fund, and after a maturity ELSS, after a maturity of 3 years, you redeem the scheme, and the amount credited to you is 75,000. So again, the ROI is 75 minus 50 divided by 50. You can say half or 50%. Again, 50% return is there. So that is the way you can use it. Some people actually use the word return and profit interchangeably, but a word of caution: the return and the profit do not mean the same always, because return on investment only touches the money you capitalize in the scheme mutual fund, and the return you make on that amount based on the profit of the complete scheme or the fund. So ROI is not the same. Don't think that ROI is the same as the return you make on your equity. So there are quite a few methods to determine the ROI to actually assess the profitability, like divide your net income after all your deductions from your total income, interest and taxes, EBITD as we call, by the overall cost and the liabilities. This will gauge your income rate in comparison to the capital invested. So the second way would be divide your net income and income taxes by the equity that you invested and other liabilities to generate an income rate on invested money. Then divide net earnings by total investments plus reserves to estimate the income rate on your ownership equity or the stocks. So of course this can be a confusing thing, the three methods that I've given you, but yes, don't confuse the return over investment with the profit. So what are the benefits of ROI actually? It is user friendly. You actually know what is the cost and what is the return you have earned, and it is one of the globally understood phenomenon. And yes, it is a versatile one. It does helps in understanding the profitability of the scheme, and also enables you to do a comparative analysis amongst other. But then there are a few limitations of the ROI as well. It ignores the time value of the money. For example, different schemes will have different tenures. A 10% ROI for a 1-year FD and the same for a 5-year ELSS can't be comparable. So the rate of return scores here as a performance metric. And the second thing, the ROI does not take the inflation into consideration. You have not deducted the inflation part, which has actually grown along with your money as well. So and plus also it does not count your processing fee, your stamp duty, or the initial cost that you might have incurred on investing in the same. So then the ROI results are very easy to manipulate as well. They can change from investor to investor, and they sometimes you cannot have different inputs to get the same value at the end of the thing. So the bottom line would be that the ROI is a ever evolving thing, and you can always, you can say the ROI, the new way is the social return over in the investment. The SOROI consider the socioeconomic factors as well, which ensures more accuracy as they use extra financial value. So thank you friends for watching this 17 videos on mutual funds. I hope your day has been there. If not all, at least many of the concepts would have been clear. Please do like, share and comment at the particular video which you feel needs a further elaboration. And yes, there are quite a few more things to discuss, but then there has to be an end to certain things at a given point of time. So maybe some other day I'll be back with more of such videos, and then we can take it from there. So do send me your feedback, what you felt about this honest attempt to educate the doctors and the dentists about the basics of the mutual funds. Thank you so much. Take care. Bye bye.